mortgage rates have done what's known as a decouple. Normally, there's this thing rich people buy. It's like a CD for rich people and big institutions called the 10-year Treasury. And the 10-year Treasury is a direct obligation of the federal government, and the rate on it normally is the marker for what you pay on a mortgage. And there's an amount above the 10-year Treasury historically that mortgage rates would set at. And right now, because a mortgage is more risky for an investor than a direct obligation of the federal government. And I should say, why the 10-year Treasury? Why that? Because I take out a 30-year mortgage. Because most people don't keep their mortgage for anywhere close to 30 years. And so 10 is kind of like a good marker. So they know, okay, so federal government, we're going to lend them money at this amount interest rate. So let's lend money to you or me buying a house at this amount more. Right now, because of a bunch of weirdness behind the curtain, you don't need to know, the spread is greater than normal between the 10-year Treasury and mortgages. That's why mortgage rates went up, and up in such a short cycle, because of odd things going on Wall Street. And so as the inflation curve ultimately bends, and let me tell you, inflation is not forever if you have the will to take it on. And it seems that the Federal Reserve clearly has the will. And it's just a matter of how much pain there is from here to there to squeeze the inflation out of the economy. And it will happen. So the mortgage rates will trend down, and they're likely, barring some unexpected event in the world, they're likely pretty much at their current peak. Because as the economy slows, which the Federal Reserve is engineering, and as inflation squeezes out, the interest rate that the marketplace will demand on the 10-year Treasury will come down, and then in turn, even though the rates have decoupled a little bit, the mortgage rates will come down as well. They are not going back to 2 or 3%. That was a market manipulation by the Federal Reserve to prop up the economy, and that's not happening. So we're going to see rates that will be lower than if you look at long historical charts, rates are going to be better. Probably, economists are all over the board about this. Based on everything I read, we're going to cycle down to somewhere in the 5s, maybe upper 4s. That's likely the territory that we're going to settle at the point that the market psychology says, okay, the economy shifted into lower gear and inflation has shifted into a lower gear, and that's when you'll see the mortgage rates start to decline. One of the guesses from one of the banking lobbyist organizations is that rates by the fall of next year, basically a year from now, will be about 5.4%. That's their guess. And based on everything I read, that's a pretty good bet. So the much higher rates we're seeing right now quoted, not likely to have long staying power, which is good news. The other thing that's great news is that most of the mortgages in the market are underwritten by Fannie Mae and Freddie Mac. You may hear these terms. They're quasi-governmental or basically governmental entities that end up supporting the mortgage market in the United States. That's why our rates are a lot lower than they are in other countries in the world, because the federal government's directly involved in the mortgage market. So FICO has been the only credit score that has been part of the mix in establishing your creditworthiness for a mortgage. Well, now the rules require that lenders also consider what's known as the Vantage score. And part of what Vantage has been about are these extended scores that for people, let's say, who've been lifelong renters and want to buy a house, will now be able to take into account how you pay your rent. How do you pay regular utility bills? How do you pay things that are normal monthly obligations but not traditional credit? The analysts believe that this kind of regular obligation payment can be used to establish pretty clearly if you're somebody who will meet your regular bill commitments or not, outside of the narrow box of items that were really the key and everything with credit reporting and scoring, which was how do you pay for a mortgage, how do you pay for a car loan, how do you pay your credit cards, how do you pay personal loans. It was all about borrowing to establish a profile on you. But the belief now is that, and the data that's available can be crunched so much more easily, that all these other factors of people that live a mostly cash existence can also illustrate whether you will meet your obligations on a debt, and this is good news.